So guys, right now we are knee deep in the middle of earnings season when companies open their books and share the good, the bad, and the ugly. And as I'm sure you can imagine, depending on the results, share prices can either soar or sink in a big way. Now, the good thing about this is that sometimes this volatility can create golden buying opportunities, which have been in short supply these last few months. And in this video, we're talking about 3 stocks that look like great buying opportunities right now as we head into November. But real quick, before we get to those, I want to hear from you. Leave me a comment below and let me know which stocks you currently have your eye on. I'd be curious to hear what you think is looking good. Now guys, this first stock is L'Oreal, and you're probably already familiar with this company. It is the world leader in beauty and holds a very diversified portfolio spanning several segments. We have L'Oreal Luxe, consumer products, dermatological beauty, and professional products. Within these segments, the company owns brands like Garnier, Maybelline, Redken, Pureology, and Kiehl's. Plus, L'Oreal is the force behind beauty products for high-end brands like Armani and Yves Saint Laurent. Long story short, L'Oreal has a lot of good stuff going on, and they are very well diversified in the beauty industry. And the industry as a whole is pretty resilient. Whether we're talking makeup, skincare, or salon-quality shampoo, beauty products like the kind that L'Oreal sells are essential to those who use them, which means they tend to be less impacted by economic turbulence than other types of consumer products. Still though, like I said, it's earnings season, and after reporting their recent earnings, L'Oreal's share price took a pretty big hit. Taking a look at the share price performance over here on Snapstock, which is my new stock analysis tool, guys, and it is now available to use. If you want to check out Snapstock, there's a link to it in the description of the video and in the pinned comment. But looking at this, we can see that in the last month, L'Oreal has taken a very big hit. They're down 11% just in the last 30 days. And if we zoom out, looking at the year-to-date performance, this is going to leave the stock down almost 19%. So in both of these departments, very, very big drops. And if we zoom out once more, over the last 365 days, the stock is down about 7.5%. And scrolling down just a little bit, we can see that it is basically right there at its 52-week low. Now, what's interesting about this recent share price drop is that the earnings were actually not too bad. L'Oreal reported solid numbers pretty much across the board. I mean, revenue for the first 9 months of the year is up 6%, which as we can see over here on Snapstock is pretty on trend with the steady growth this company has been delivering over the years. So we see a nice trend in the revenue chart here. You know, the earnings per share is a little bit spotty. 2014 and 2018 were pretty down years, but overall the general trend in the earnings per share is up and to the right. And the same is true with the free cash flow per share. It's not super steep, the slope on this chart here, but we can clearly see the free cash flow per share is growing over the years. I'll tell you what though, not everything was perfect with L'Oreal in this earnings report. I mean, like many companies, they did struggle in China this quarter, which was the only region where the company reported negative growth. Still though, I think L'Oreal is a great dividend growth stock to consider. And if we take a look at the dividend stats back over here on Snapstock, we can see that in the trailing 12 months, it has the yield super high. I don't believe this is accurate. I think it's closer to what the 5-year yield is, about, 1.3%, the 10 years 1.6%. So right now the current dividend yield is somewhere within this range. So, mid 1%, not the highest yield, but the dividend growth has been great. Their 5-year CAGR is about 10.5%, and this is exactly what you want to see, guys. With that, if we scroll down just a little bit, looking at the payout ratios, the earnings payout ratio is actually going down over time. So it looked like it peaked right here in 2020 at about 61.5%, and since then it has made its way down, and now in the trailing 12 months is sitting below 40% at about 37.5%. So that's looking good. The free cash flow payout ratio is also in good shape. It looks like they peaked in 2022 at 59.2%, and now it's down even more, about 54%. So still plenty of buffer there. Anyway, guys, now moving on to stock number 2. This one is ASML, which is the world supplier to the semiconductor industry. Now, essentially what they do is design and manufacture photolithography machines, which is quite the mouthful, but essentially these are the types of machines used to create semiconductor chips. And in a nutshell, photolithography is the process of using light to print very tiny, very intricate patterns on silicon wafers to create microchips. Now, as I'm sure you can imagine, these machines are incredibly advanced, and ASML is actually one of the only companies on the planet that makes these machines. And given the growing demand for semiconductors, this monopoly positions ASML as an essential player in the semiconductor supply chain. But anyway, taking a look at the share price performance, we can see that ASML really jumped off a cliff right here about midway through the month. This is where they reported their quarterly earnings. We'll talk a little bit more about that in just a moment, but overall this performance resulted in a 12.4% decline for the month, so a very big drop. But if we zoom out looking at the year-to-date performance, performance, still ASML is in the green. They're still up 2%. And if we zoom out once more over the last year, this company is still up 20%. With that said, though, going back to the 1 month performance, this drop right here, which came from their earnings, the biggest catalyst for this drop was something called bookings. In ASML's financial reports, bookings refers to the total value of orders that customers have placed but haven't received yet. And in a nutshell, bookings show the demand for ASML's products. Now, because bookings are basically future orders, they give a sense of what ASML's future revenue could look like. A high booking number means strong demand, not only for ASML, but also for the industry as a whole, while a low booking number could indicate the opposite. And in ASML's most recent earnings, while they reported a 20% quarter-over-quarter increase in sales and a 32% increase in net income, the bookings came in 53% lower than expected, and that's what sent the share price plummeting. With that said, though, I think this should leave ASML shareholders and those who want to be shareholders jumping for joy because the growth from this company is just insane. So I would welcome the opportunity to buy shares at as low of a price as possible. And looking at the dividend stats, clearly the growth isn't just limited to revenue and earnings per share. I mean, the starting yield isn't the highest by any means. In the trailing 12 months, it's only 0.75%. Definitely nothing to jump out of bed for, but the 5-year growth rate on the dividend is phenomenal, guys. This is a real work of art. Almost 22% over the 5-year period, and the 10-year CAGR is even better at 31%. With that said, though, if we look at the chart here, we can see that the dividend did take a slight dip between 2022 and 2023. And one thing that's important to keep in mind is that ASML is a European company, and they typically have different dividend policies than what we're used to here in the United States. And so, therefore, the dividend growth may not be as linear, so that's just something to consider. Otherwise, though, ASML has been a beast of a company, and it's got quite a few tailwinds working in its favor that I think at least make it worth considering, especially at the current price, and we'll see where the price goes from here. And now, guys, moving on to stock number 3, this one is a company that needs no introduction. We're talking about Nike, and this is actually the 3rd time this year we've featured Nike in one of these monthly stocks to buy videos. It was featured back in January when it was at around $100 per share. Then we brought it back a couple months later in March when it was at $93 per share. And now, as we can see, Nike is at $78.91 per share, which is considerably lower than the last time we talked about it. But in the last month, Nike's seen another 11% dip. It looks like just here in October, it's gone from being at about $90 per share to, where it's at now. So quite a big drop for these guys. And if we look at the year-to-date performance, it's even worse. Nike's down about 23.6%. And if we zoom out once more over the last year, they're down 22.4%. And just like the other 2 stocks, Nike fell yet again after reporting their quarterly earnings, where even though they did beat earnings expectations, they missed on revenue and also delivered a 10% decline in sales compared to this time last year. The silver lining to this, though, is that as the share price goes down, that dividend yield just keeps getting pushed up. And right now it's sitting at about 1.5%, which is quite a bit, both the 5 and 10-year average yield. So you're able to get a nicer cash flow return than usual. And Nike is a dividend growth monster, guys. This is pure class. Look at that chart. And the 5-year growth rate's pretty sweet at 11.3%, and the 10 years even better, just over 12%. Not to mention, if we scroll down just a little bit looking at the payout ratios, the dividend is still very well covered. I mean, in the trailing 12 months, it's sitting at about 43%, so definitely not cause for concern. And if we look at the free cash flow payout ratio, this is actually lower at 36%. So from this, it doesn't look like the dividend is at any risk of being cut anytime soon. Overall, Nike is looking better than it has in quite a while. I definitely think it's worth considering, and I think the same is true for all 3 of the companies that we looked at today. With that, though, these 3 aren't the only ones. There are still quite a handful of other companies out there that I think you need to keep your eye on. The first of which is going to be Dolby Laboratories, ticker symbol DLB, who's down about 2.5% in the last month. Not a crazy drop there, but if we zoom out looking at the year-to-date performance, the drop is even bigger. They're down 12%, and if we zoom out once more over the last year, they're down 7%. So I do think this is a good one to keep your eye on. Anyway, moving on to stock number 2, this one is Elevance Health, ticker symbol ELV, and I gotta shout out my man Kevin Burgess. I know he just added this one to his portfolio, and rightfully so. It's down quite a bit in the last month. They dropped big time, almost 21%, and if we zoom out looking at the year-to-date performance, they're down 13.5%, and if we zoom out once more over the last year, ELV is down 7.4%. 4%. So definitely keep your eye on this bad boy. Moving on, this stock has been the talk of the town lately, guys. Genuine Parts Company, ticker symbol GPC. A very big drop for these guys. They're down 15.7% in the last month, which is going to leave them with a year-to-date loss of about 12%. And if we zoom out over the last year, GPC is down 6.2%. So another good one to watch. Now, guys, moving on, this next stock is one that just can't seem to catch a break. We're talking about the Hershey Company, ticker symbol HSY, who's down about 5.6% in the last month, so a decent drop for them. And this is going to leave them with a year-to-date decline of 3.2%. And if we zoom out over the last year, they're just barely in the red. They're down about 0.25%. But if we scroll down a little bit, we can see that the Hershey Company is sitting right there at their 52-week low. So I think this is a good one to consider. And then next up, guys, we have a very iconic company. We're talking LVMH, who's seen a crazy drop in the last month. This one has seen quite a big drop this year, actually. If we zoom out looking at the year-to-date performance, they're down about 10%, and they've really come off their highs from earlier this year. So I do think this is a good one to watch. And then moving on, guys, this next stock is Merck, which I don't know if I've ever really talked about before on the channel, but they've seen a really big drop in the last month. They're also down about 8%. And if we zoom out looking at the year-to-date performance, Merck is down about 7.6%. So a good one to keep an eye on. But anyway, now this seventh stock is Insperity, and we've talked about this one quite a bit on the channel. I think we featured it maybe 2 months ago. There might have been a couple times we featured Insperity this year, and they're having a really good day. They're up 4.6% just today, but still in the last month, Insperity is down 3.3%. And if we look at the year-to-date performance, it's a crazy drop. Insperity is down almost 27%, so definitely a good one to watch. And with that, guys, this next company is one that I really like a lot. This one is sitting on my watch list. It's Zoetis, ticker symbol ZTS. I've talked about it quite a bit on the channel, and in the last month, Zoetis is down about 5.6%, so a pretty decent drop here. And if we zoom out looking at the year-to-date performance, they're still in the red. They had a, big dip right in here, and then they've kind of since recovered, but overall still year-to-date, Zoetis is down 5%, so I think this is a great one to watch. But anyway, those are all of the stocks that I think you should keep an eye on, and in this next video right over here, I'm telling you about another stock that I think is looking great, and this one I'm actually buying. I just added it to my portfolio a few weeks ago. But anyway, in this video, I'm going to tell you all about this new investment and why I decided to buy it. So click right over here to check that out, and I'll see you in the next one.